Hello, welcome to the stock play of the day. Today's stock is GLD. That is the ETF that tracks the price of gold. We'll discuss, should we pass or should we play? Hello, everyone. My name is Brian Overby. I'm the Senior Options Analyst with Ally Invest.
And I'm Lindsey Bell, Chief Investment Strategist with Ally Invest.
All right, Lindsey, we have a chart of the S&P 500 index, and we have a big earnings week coming up. What do you see going forward this week in the markets?
Yeah, I think the focus is definitely going to be on earning. It's a really big week. 36% of the S&P 500 is going to report their earnings results, and that includes some of the big tech names that have been leading this market higher. On Wednesday, we get Facebook. On Thursday, we get Amazon, Apple, and Google. So investors will certainly be keeping a close eye on that. But again, we'll get a variety of earnings from across the 11 different sectors in the S&P 500. So it'll be a busy week. But also we have the Fed meeting that starts tomorrow and ends Wednesday. We'll get a statement from the Fed. No one really thinks that there's going to be any interest rate changes. Remember, Brian, last month in June, at their last meeting, the Fed said they're not even thinking about raising interest rates. So I think they're pretty set there. Interesting to see what about potential additional stimulus from the Fed going forward. And this morning, the markets were pretty pleased with what they heard out of the GOP and their proposed stimulus plan for combating the coronavirus slowdown going forward. Because guess what? At the end of this, we have a lot of the stimulus that's been in the system expiring, including unemployment benefits and evictions and foreclosure forgiveness for the period of time that was originally put into place. The GOP said, look, we're going to put that $1,200 check back in the mix. We're going to look at employment insurance and make sure individuals are being paid 70% of what they were making when they were working. The eviction forgiveness will be extended. There wasn't any money in there, though, for state and local governments. But anyway, the market was pleased, and then the goods number came out and kind of took a little bit of steam out of the day, but we're still in the green. And you know what else is green, Brian? Is the NASDAQ. It is once again green today going into this big week of earnings, like I mentioned, with all those high flyer names set to report. What are you seeing from a technical perspective? I know you and Callie put a trade on this a couple weeks ago. What are you expecting this week?
Yeah, in the stock play of the day a few weeks ago, we talked about the QQQs, which is the ETF that tracks the NASDAQ. We just talked about that one a little bit. But as always, whenever we're looking at these charts and everything, these aren't meant to be recommendations. We're just trying to learn a little bit here about the markets. If I look at the NASDAQ overall, what I see is something that's a little frothy, and I think that we had some profit taking at the last couple of days and actually last week. And we see that this is the 200-day moving average. And when I refer to being just a little bit overdone, is that you see we're over 100 points away from where the current market is at right now. The 20-day moving average all the way through here was kind of providing an area of support, and we actually broke through that for the first time. And I do think it's the nervousness that of all these big tech stocks that are going to be announcing earnings. Now, we had a few other stocks that aren't quite FANG stocks, not part of that mix, but we had Microsoft last week announce earnings and a few other big name tech stocks. Now, this week, we're really going to get that 1, 2, 3 punch on Thursday, where we see, as you mentioned, we see Google, we see Apple, and we see Amazon for the first time in a long time, all reporting on the exact same day. And for for option traders, that's really interesting in that that means you have an option contract that will last only one day until that expiration, because the weeklies, they'll announce Thursday after the close, and then you have all day long Friday, and that's all that those options live. So I expect a lot of volume in those underlyings because of that fact. It just makes it a very interesting dynamic when trading options. All right, so now stock of the day, let's talk about gold, GLD.
GLD, yeah, let's do it. Like you mentioned, GLD is actually an ETF that tracks the gold market, and so it trends in the same direction as gold primarily. And so here we see a chart going back to 2009. We're showing you this because on Friday, gold, the yellow metal, the actual metal, hit a new all-time, and then this morning GLD doing the same thing on an intraday basis, as you can see here. So exceeding that last, which was in 2011 after the great financial crisis. We saw that run off the left-hand side of the screen from 2009 to 2011, where, you know, people usually flock to gold as a safe haven asset. And Brian, you and I talked about this back in March as a potential trade. So we encourage our viewers to go back and check that out. And while I am talking about that, just a reminder to all our viewers, a couple things before I get further into the fundamentals of GLD. Just want to remind our viewers that Brian and I do take questions at the end of the show from you. So please feel free to chat with us in the right-hand box there. We will answer any questions that you have, either for Brian or myself. We're happy to get them at the end. And yeah, just type them in the box there. And then also just a little item just to our viewers that anything Brian and I talk about on the show shouldn't be considered a recommendation or investment advice. But without further ado, let's get into the meat of it. GLD, I mean, it's had a spectacular run. It is up almost 9% in the past month, 27% in the past year. There's not many other asset classes, you could say, that have done that. And you can see it right here in the chart. And what has been driving the price of gold more recently, obviously being a safe haven, economic uncertainty is a key driver. And that's been going on since March, since we first started looking at this. Given the uncertainty around the coronavirus pandemic here in the U.S., we know cases continue to spike in different states. So it's, you know, we're seeing it turn to the days of the virus back in March here. So that's been driving this product more recently. Also, what's been interesting is interest rates. Brian, you and I talk about the 10-year all the time and how low it's been. You know, at one point we were getting closer to 1% on the 10-year, but we've been around the 0.6, 0.7% for much of the last several months. And in the last couple of days, we've seen it dip under 0.6%. So that means investors are getting a little more nervous, flocking into fixed. That's a good thing for gold. In addition, the dollar has been declining. It's down about 3.8% in the past month. If you look at the ICE dollar index as one measure, it measures the dollar against 6 different other currencies. And so the thing about is when you look at the dollar and interest rates, there's an inverse relationship between the price of gold and interest rates, the direction of interest rates in the dollar. So interest rates are going, the dollar is really good for gold, which is why you're seeing GLD pop. And the dollar really, like I said, in the last month has made that big move down. And so that's helped gold significantly. Also, you just see geopolitical tensions rising between the U.S. and China once again. And then additionally, Brian, we covered Barrick Gold back in May. Mm-hmm. One of our trades is another play on gold and a safe haven asset. But a lot of the miners, they're actually reducing the supply of gold out there. So what does that mean? They're spending less on CapEx, and that also helps prop up gold, maybe not to the extent that you from interest rates and dollar movement impacting the price of gold. But that's basically the underlying fundamentals of what's going on. Now, one thing that's different this time around versus what we saw back in 08, 09, going into 2011, is that we're not seeing the demand for physical gold. So from India and China, those are big regions that use to make jewelry. And the demand for jewelry has been depressed because of the coronavirus pandemic. But that's been okay because the financial demand for this asset class, the physical demand. So that's one thing that you got to watch for. If there is any pullback in the demand on the financial side, will the physical side be able to pick it up? But I mean, I think the setup looks pretty. Like I said, Congress, the Republicans today releasing their new bill for stimulus for the economy, and it's not just the U.S. Governments around the world continue to throw money at their economies to help stimulate them in the wake of the coronavirus. So that's what we're looking at from a fundamental perspective, Brian. But before we leave this chart and get into an options paper trade, what are you seeing from a technical perspective? Because this chart looks pretty interesting to me.
Yeah, it does. And we're looking at a weekly chart. And I do need to emphasize this. This isn't a daily, but we're looking at a weekly chart. And when you look at a weekly chart, one of the more popular technical analysis things to look for is what's called a cup and handle. And you can kind of see that this has been a long time in building, but here's the all-time high in GLD right over here. And then you kind of see that. And I'm just going to draw it slowly with my cursor. You see a little bit of the handle, and then you got the little smile in here. That would be considered the cup. And it's coming back over to these highs. So on a momentum and a charting basis, if we could break through to new highs, that would definitely be a good thing overall. And as far as technical analysis is concerned, and when you're seeing new highs in stocks, overall, that's usually considered a good momentum play. So with that said, based off of the chart, let's get into the options strategy. And we're going to do something to try to get us out towards the end of the year. If I look at the Ally Invest option chains, we see that gold is having a good day today. It's up 1.8%. That's not quite its highs. Came off a little bit off its highs. It's 181.97. Once again, like I said, this is the gold, the GLD ETF. These are all the different expirations. We have a lot to choose from. I'm going to pick the October 16th expiration. And one of the things that I like about gold relative is that if you look at the implied volatility column here, and I'm going to scroll down a little bit, we're going to go a little deep into money today with our option trade, but that's 81 days away. This is the implied volatility column, and we're right around 22% implied volatility. So relative to the rest of the market, we have the VIX index today trading at 25%. That's the volatility index that tracks the S&P 500 index. So overall, the volatility in gold, the implied volatility, isn't bad relative to the rest of the marketplace, being down in the 20s. That means that the options are fairly affordable. I'm not going to say they're overpriced or underpriced, but in general, we can buy a little bit in the money option contract and get some value there based off of the implied volatility. So the strategy that we're going to look at today, I'm going to have to go to the rookies corner inside the options playbook. Inside the options playbook, we see the tab for the rookies corners, and we see buying leaps as a stock substitute. Now, that just means we're going to buy an in the money option contract, and we're going to go out further in time. I'm not going out 9 months in time, which is the traditional definition of a leaps option. That just stands for long-term equity anticipation securities. Overall, it's just a fancy marketing term for longer-term options that the Chicago Board Option Exchange came up with. But here is the strategy inside the playbook, and we have a lot of details about it because it's just an alternative. You're trying to buy in the money option contract and use it as a surrogate for the stock. So what do I mean by a surrogate? If I'm going deeper in the money, I want to get a higher delta, which is outlined inside the options playbook. If I have a higher delta, I get more stock representation. So let me get to the right tab here. So in this instance, we're going to go out 81 days. We're going to go out to October, that kind of scary month as far as market downturns are considered. A lot of them have happened in October, and actually a lot of volatility usually goes on in September. So if I look at that October expiration, we're going to go and literally just look at the delta column. And I see a delta right here of 80 on the 168 strike. So we're quite a bit in the money. It's a fairly expensive option contract, but another good thing about gold is that we have decent volume, fairly decent open interest in it. So a lot of times the markets aren't bad. And this is one of the things, I'll be blunt, that if markets weren't a little bit wider in the leaps options, you would get more people doing them than probably even buying the stock. One of the bigger issues about trading longer term or deeper in the money option contracts is the bid-ask spread will usually be wider than it would be in the underlying stock. And that's the case here, but it's not outrageous, right? We're getting a lot of bang for our buck. We're buying an 80 delta option contract, which means that if the stock goes up 1, this option contract should go up by about 80 cents. And there's another way to look at this, and I'm going to give you a little trick that we used to use at the Chicago Board Option Exchange is to kind of confirm that 80 delta makes sense. If you look at the 167 strike call option, and I'm just going to go from ask to ask because it's working out really well. Now remember, these are live trade, these are live quotes that we're dealing with. But on the ask, it's 16.20 for the 168 strike. For the 167 strike, it's $17. What's the difference? 80 cents. What's the delta? Delta is a theoretical number, but it's around 80 cents. That means that if the stock did go up 1, the 168 strike call should be trading for what the 167 strike call is trading for. So that's what I mean by delta. Delta is a theoretical number. It gives you a realistic expectation as to what your underlying option contract could move. So as opposed to just buying the stock outright, an alternative would be to buy a deeper in the money leap option. And as always, not meant to be a recommendation here on the stock play of the day. So we're just trying to learn, but I'm going to put a little checkbox in here and put a little B there, and that's going to go down into our workbench, and this is going to be our official paper trade for the week. And let me even put it over in the right rail. The paper trade would be that we're going to buy to open one of the October 16th expiration call options. We'd try to work the trade a little bit. There's never guarantee of a midpoint fill, but let's call it $16.15. That means that you times that by 100, so you're paying $1,615 plus commission. That would be your total risk for this trade if you bought one option contract. And your outlook for the market then is to the upside. So if I look down and I look at the profit and loss graph, as with any long call option, you have substantial upside. It's basically like owning long stock all the way on the upside, but you have the little hockey stick figure on the downside. The maximum you can lose is what you pay for it, and that's your risk going all the way out to that expiration date. It's going to be limited, and it's going to be known. Now, no, I'm getting a little bit long-winded, but with that said, if you still think that's a fairly expensive option contract, another strategy you just might want to look at, and I'm just going to highlight here in the option strategies inside the Ally Invest Options Playbook, and that strategy is actually called the fig leaf. And the fig leaf is an alternative to a covered call. A lot of people call it the leveraged covered call position, but it just basically means that we'll sell some shorter term option contracts against our long call position. So this is the strategy I'm not going to highlight. I don't usually highlight two strategies here, but this is an alternative looking at just buying a leap as a substitute for stock and get a little bit of the stock, or I should say surrogate would be a better word, because you're looking at getting about the relative type movement that you would in the stock with an 80 delta. And here we have the fig leaf. So this would mean I'm just going to sell a near-term call against it, higher, out of the money, and I'm going to treat it almost like a covered call option. But if you're doing the fig leaf, realize you don't own the stock. So that's kind of where the fig leaf came from. So we say you're kind of covered because that's where the name came, and then we termed it inside the options playbook. You're kind of covered because you have something that looks like stock, but it's not stock. So if you do get assigned, you're going to have to do something in order to meet that assignment because you're really just long a call option. All right. Well, that was a little bit long-winded. Lindsey, let me get up the trade of the day over here real quick. And do we by chance have any questions in the chat box?
We do. We've got a pretty chatty group today, which is really great. Are you placing the trade, or do you want to answer some questions?
I'm happy to answer some questions.
Okay, so we've got a few. This cat pack bell is asking, how do you close out the leap option?
How do you close out the leap option? Well, this is great. Now, if you're showing my screen still, I can actually, I'll go through the steps inside the Ally Invest option trading platform. Here we were showing that in our strategy workbench where we're just reviewing the trade, we see the delta, we see the bid, mid, and ask price, the implied volatility of the option. Now, that's where you're actually doing your research. But over here on the right rail, this is actually an order ticket. And if you bought to open that long-term option contract, and we said $16.15, market's running right now, but with that being said, that's the price that we'd be looking at. When you go to close, all you would do is put that same option contract in there, but the vernacular changes. It would be, instead of buying to open, you'd be selling to close. And then this order would be looking to be done for a net credit to the account, hopefully, if we have some value left in our option contract. And that's how we would actually close out this position using the Ally Invest option chains. Great question.
Yeah, Kayamana has a couple questions for us. First, is he says, Lindsey, I think you pick the stock each week. How do you choose? Well, actually, Brian and I get together every Monday morning to think about which stock or ETF that we want to talk about. And, it's driven on a bunch of different things. What's moving in the market, and what do we think is coming down the pike? And Brian looks at different levels of volatility and things like that, right, Brian?
Yeah.
Maybe you explain what you look at a little bit up with that.
Yeah. Well, you cut out a little bit there, but yeah, in general, if we're just looking at one of the biggest things that we do want to make sure that we're looking at options that are fairly liquid. In other words, you can get in and out pretty easily. So we usually talk about stocks that have a little bit more volume overall, that are a little bit more popular, because if the stock doesn't have a lot of volume, the options trades won't have a lot of volume. And so we want to steer clear of illiquid option contracts. And I actually have that in inside the options playbook website in the white paper, the top 10 mistakes. I talk about one of the bigger mistakes is trading underlyings that don't have enough volume. So you're always paying a wide bid-ask spread when you're trading your option contracts. So overall, we just kind of chat about what's going on in the markets, take a quick peek at it, and then just make sure that there's enough volume for the option contracts to be liquid overall. All right. Any more?
Yeah, so he also asks, and I think we explained it, do you use, a lot of people look at charts, and that is something that Brian and I look at. Neither of us are technicians, but we do look at the technicals, the trends in the chart. And that's what Brian highlighted, the cup and handle in GLD today. So that is definitely something we take into consideration. And, I look at stocks based on fundamentals by training, but technicals has always been something that I also take into consideration. And then he also asked one last question. What's the best way to look at these types of charts, Brian? What do you usually look at? The weekly, the monthly, the daily?
Well, in general, you'll look at all of them, and I know that kind of sounds like a cop-out. I'd say the most looked at chart is usually a daily, but like in this instance, when you're looking at a long cup and handle pattern that's forming, I'm sure more people will be kind of noticing this pattern overall, but the cup and handle pattern is more of a weekly type strategy. When you're looking at moving averages and you're looking at channels, a lot more people will look at the daily, but overall, the concepts still apply to each different time period whenever you're looking at it. Now, once again, I'm not a chartist, so in general is all that I'm talking about here. But I'd say the daily is probably the more looked at time period over a 3-month period or a 6-month period, but just in general, that daily time frame. All right.
We're getting a bunch of questions here, Brian.
Okay.
So here says, how does volatility crush after earnings affect leaps? Oh, an earnings crush affect.
No. I got the gist of it. So in general, usually when you buy longer term options or options in general around earnings, now gold definitely doesn't have an earnings per se, like an underlying stock. But when you're buying option will come off more times than not, we'll say. We can't always say 100%, but most of the time they will deflate a little bit in implied volatility. So one of the things that I did, and so this kind of leads into why we did the long-term leap and why we looked at buying, and I'm going to click on that inside the options playbook here, but why we looked at buying an 80 delta option contract. If you have a higher delta, that means that you're buying more intrinsic value and less time value. So if there was earnings on gold, and we were doing this around gold, I'm trying to find the little chart, you would know that, okay, I have, by looking at the put, I see there's about $2, we'll call it $2.10 worth of time premium, approximately. It's just a quick way to try to figure out time premium on an in-the-money call. On our $16 long call option contract. So if I look at that, I know that this is all that implied volatility can mess with. That's all that time decay can mess with, is this $2. So if I buy more intrinsic value and have less time value, that's a way to try to combat any fluctuations in implied volatility and also in time decay. Now, ideally, if this was a 100 delta, which means we went way deep in the money and that it acts a lot like stock. Stock goes up 1, the option contract would go up 1, and that would be the concept of 100 delta or 1.00 delta. Well, then you shouldn't have any time premium in it, and you're going to be paying up for that option contract quite a bit, but now you're just dealing with the stock price movement, and you're taking out that headache of the fluctuation of implied volatility and time decay. All right. I think that's going to be it. Is that it for the last question?
Gold miners quickly say, we looked at bear back in May, and the price of gold soaring certainly helps the gold miners. And as I mentioned in my portion on GLD, the miners have been limiting supply. They've been reducing CapEx. So, and there's been a lot of M&A in this space. So if you look at I just did a quick look at Barrick Gold, and it's doubled since its bottom, from $15 up to $30. But these guys should also continue to benefit just in the same way that G will forward. Another question, Brian, from Amit is, should you wait for GLD leap trade after the stimulus announced? I'm thinking that stock market will rally, and that depresses GLD option prices. Well, I don't know about, Brian, I'll let you ask the question about options. The markets are efficient mechanisms, and they knew that the stimulus was coming down the pike, and even though a deal hasn't been agreed on yet, we've heard now from the Republicans and the Democrats. So that's priced into the market. But how does it impact option pricing, Brian?
Well, overall, if you're doing the trade, and once again, not meant to be a recommendation, these are just considered paper trades. We're trying to learn. And specifically, if you're trading option contracts, you want to understand how these options move before you dive into it. But with that all said, exactly what I mentioned about implied volatility still applies to this conversation. So if you're buying this as a surrogate for owning the GLD or 100 shares of the GLD, by going deeper in the money, the the time premium and the susceptibility to that all kind of, it just makes it more palatable by going a little bit deeper into money. But then again, you're adding risk because the deeper you go into money, the more you're paying for that option contract. And what you pay for that option contract is your total overall risk of that trade. So it's all about, do you feel going into this that the stimulus may be coming out, that it's not priced in? That's all about your forecast and how you want to approach this as to when you might actually jump into the gold options.
And then just really quickly before we go, Brian,
okay.
And James asks, should the XBI trade, should that have been taken off last Friday?
No, we looked at the XBI trade, and we actually haven't mentioned this yet. We'll be back actually Thursday. Oh, no, it'll be this Friday this week. We'll be back this Friday, and we'll be looking at this trade in the GLD. Last week, we did a stock play of the day overtime on Friday. The market had moved against it. What we talked a little bit about was just letting the trade play out overall. The stock did make the move that we were looking, but it just made it to the downside instead of the upside. And that was one of the nice things about the back spread that we did in the actual biotech ETF. So if you want to learn a little bit more about that, look at last week's overtime edition of the stock play of the day. And if you want to learn more about this trade as the week goes on, tune in this Friday at noon for the stock play of the day overtime, where we'll be looking at the gold paper trade that we did this week.
Yep, and that'll do it, Brian. That's all that we have the time for. I know there's still a couple questions in the queue that we didn't get to, but maybe Brian will touch on some of them in the overtime show on Friday again at noon. But that's going to do it for today, guys. Thank you for tuning in.
All right. So don't forget to click subscribe and ring the bell, and we'll see you this Friday at the Stock Play of the Day Overtime Edition.